Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
All right, let's get right to it. As of the closing bell on the New York Stock Exchange, February 4th, 2026, NIO is trading at $4.41. That's down about 3.14% for the session. We saw it open at 454 and just sort of slide throughout the day, which, mirrors that broader cooling we've seen in Chinese EV equities after the January delivery reports came out.
In the volume tells its own story here. Average daily trading is hovering around, 25 million shares on the NYSE? But we've seen these spikes, during news events that go well over 50 million. Right now, though, the stock's just sitting in this very specific consolidation phase. It's trading just under its 200-day moving average of 484, and it's really struggling to break that Fibonacci pivot point of 477. It's well above the 52-week low, but when you zoom out to that historic high of $62, the compression is just undeniable.
Precisely. And that compression, it brings us right to the central question we need to talk about today. We're looking at a company that has just issued a historic profit alert. So the question is, does this signal a genuine pivot to profitability, a buying opportunity, or is stock just fundamentally capped by geopolitical headwinds in this brutal domestic elimination round that makes it a value trap? My position is that NIO has successfully made the transition from a cash-burning startup to a diversified, defensible business, and a massive re-rating is due.
And I'm coming at this from a different angle. Look, while the profit alert is notable, I'd argue that the valuation is compressed for a reason. The structural risks, I'm talking about fierce competition from Xiaomi and BYD, and a reliance on an infrastructure model that faces, frankly, technological obsolescence, it all suggests the upside is far more limited than the bulls believe.
I'm going to start then by anchoring us in the news that broke this morning, February 5th. This is, in my view, the holy grail moment that long-term investors have been waiting for. NIO's board issued a preliminary profit alert for Q4 2025. For the first time in its history, the company expects to report a quarterly adjusted profit.
It is a significant headline, I'll grant you that.
It's more than a headline. We're talking about an expected adjusted operating profit between 700 million and 1.2 billion RMB. And even more critical for the institutional crowd, they're expecting a GAAP operating profit of roughly $29 to $100 million. Compare that to the 5.5 billion RMB loss in the same period of 2024. This just destroys the cash burn narrative. It proves that with cumulative deliveries now past 1 million units, the company has finally achieved scale, they've optimized costs, and they're ready for a long-term bull run.
Okay. I see why you think that, and I'm not dismissing the numbers. A GAAP profit is a milestone, but let me give you a different perspective on the setup. You mentioned the price is 441. The technicals are, they're screaming caution. The RSI is sitting at 47.1. It's neutral. It's not screaming oversold buy. And we just can't ignore the lingering shadow of those GIC allegations from late 2025. Singapore's sovereign wealth fund raising serious questions about revenue inflation.
Which the company has vigorously defended against.
Defended, yes, but the market hates uncertainty. Until the audit resolutions are final, that creates a ceiling. And look, one profitable quarter doesn't just erase the macro environment. You have EU tariffs sitting at 20.7%. And you have Xiaomi Auto, a brand new entrant delivering 410,000 units in 2025. That is a massive threat to NIO's ability to sustain the very margins you're celebrating.
Well, that brings us directly to the financial health and the business model, because I think the market is missing the nuance in those margins. You look at Q3 2025, vehicle margin improved to 14.7%. That's up from 10.3% the previous quarter. That's not some accounting magic. That is material cost reduction and a better mix of high-end models. But the real story is that NIO isn't just selling hardware.
You're talking about BOSS, battery as a service.
Exactly. BaaS. This is a recurring revenue stream. By separating the battery from the car, they lower the entry price by up to 30%, which expands their market, and then they lock the user into a subscription. It's a classic ecosystem play. Plus, look at the cost control. CEO William Li has shifted from growth at all costs to what he calls discipline for profit. I mean, the man is tracking supply chain costs to 4 decimal places. That is the behavior of a mature industrial CEO, not a startup founder.
That's a compelling argument, but I have to push back on the peer comparison. You're celebrating a 14.7% margin. Okay, look at Light Auto. They're sitting at 20.4%. Why? Because they use hybrids, ERVs, which keeps battery costs way down. NIO is pure BEV, which is just inherently more expensive. And as for the ecosystem play, the market isn't valuing them as a tech platform. NIO trades at what? Roughly 1 times price to sales. Tesla trades at 15.7.
That gap is the opportunity.
Or that gap is the reality check. The market sees them as a hardware manufacturer with really high overhead. The skeptics are asking, is this profit sustainable, or is it a one-off driven by aggressive cost-cutting that's going to hurt their long-term growth?
I'm just not convinced by that, because it completely ignores the moat they've built with infrastructure. Let's talk about the swap stations. This is the most misunderstood asset on their balance sheet. NIO Power now operates over 3,000 swap stations. For years, the bears said this was a capital expenditure black hole. But now, it's becoming an open utility. They have partnerships with Geely, Chery, Changgong.
It's a large network, certainly.
It is a massive network, and it's shifting to an asset-light model. Partners like Sinopec are now providing the land and the capital for new stations. NIO just provides the tech and the operations. They have solved the CapEx issue while establishing the industry standard.
I see the utility argument, but have you considered the technology risk? This is the white elephant thesis. We are on the verge of the solid-state battery revolution. Competitors like Chery and SIOC, who you just mentioned as partners, are targeting mass production of solid-state batteries by 2026, maybe 2027.
Well, NIO is also working on solid-state tech.
True, they have the 150 kilowatt-hour semi-solid pack, but here's the risk. If solid-state batteries allow a car to charge fully in 5 minutes, does a multi-billion-dollar swapping network become obsolete? I mean, why would I pay for a swap subscription if I can charge as fast as I fill a gas tank? NIO is betting the farm on a bridge technology that might be disappearing right as they're trying to monetize it.
That assumes a rapid infrastructure rollout for 5-minute charging, which is, that's decades away in terms of grid capacity. Swapping is the solution for today and for the next decade. And speaking of the next decade, we have to look at the market expansion. It's not just about the NIO brand anymore. We have the multi-brand strategy fully operational.
You mean Onvo and Firefly?
Yes, Onvo is attacking the mass market, going right after the Tesla Model Y. Firefly is their smart small brand for cities in Europe. This diversification lets them capture volume without diluting the premium NIO brand. And about Europe, that price undertaking agreement with the EU in January was, frankly, a masterstroke. It lets them bypass some of that tariff pain by agreeing to minimum prices.
It bypasses the tariff, sure, but it creates a pricing problem. If you agree to a minimum price to avoid the 20% duty, you're forcing your mass market Firefly brand to be priced higher than European competitors who don't have that floor. It hurts competitiveness, and we can't ignore the elimination round happening in China right now.
It's competitive, absolutely.
It's a death match. Xiaomi is targeting 550,000 units in 2026. They are eating into the tech-savvy demographic that used to be NIO's stronghold. And Tesla and BYD can afford price wars because of their scale. NIO has to maintain premium pricing to protect that margin we talked about. If they get drawn into a price war, that profitability evaporates. And let's be clear, the U.S. market is closed, 100% tariffs. Their addressable market is China, Europe, and the Middle East.
Limits can sharpen focus, and they are focusing on technology. The NIO World Model rollout to 460,000 vehicles shows they're leading in AI. This keeps their software premium. But I want to pivot to what this means for an individual investor. Let's talk about the money.
Yeah, let's do the math.
Okay, if we look at a $5,000 investment scenario at today's price, $441, that gets you about 1,133 shares.
Right.
If you believe in the midterm projection, let's say 2029, where they fully ramp Onvo and Firefly and have consistent free cash flow, the midpoint estimate for the stock is around $18.90. That turns your $5,000 into roughly $21,400. That's a 328% ROI.
And if you look at the real bull case for 2030, assuming they become a global heavyweight, we're talking about that 5 grand becoming over 51,000.
Those are beautiful numbers on a spreadsheet, but let's look at the short-term reality. The Wall Street consensus target for the next 12 months is $6.67. That gives you a value of about $7,500. I mean, that's decent, sure, but it is high risk. And you have to ask yourself, do you trust the leadership to navigate this elimination round?
I absolutely do. William Li, the mobility godfather, has immense skin in the game. He holds a 6.54% stake worth almost $790 million. He didn't sell during the highs, he held. He invested his own money during the 2019 crisis. And institutional backing is strong. CVN from Abu Dhabi, Tencent, the smart money is holding.
William Li is charismatic, and his survival instinct is proven. But while he holds, I'm not seeing a massive new insider buying frenzy. If the stock is such a steal at $441, why aren't the executives loading up right now? The investment depends entirely on what we call the blue sky scenario. If Onvo fails to capture volume from the Model Y, or if Xiaomi continues to dominate the conversation, that $5,000 could just stagnate.
I see it differently. That institutional presence, specifically CYVN, provides a capital safety net that other startups just don't have. They have the runway to execute the strategy.
It's a runway, but it's a narrow one. And look at their delivery numbers from January. 27,182. Yes, that's up 96% year over year, which is impressive. I'll give you that. But sequentially, it shows the seasonality and the pressure. If that growth slows, the service revenue doesn't scale fast enough to cover the infrastructure costs.
But 96% growth is the headline number. You can't just brush that aside. While BYD declined 30% in January, NIO grew 96%. That proves the brand differentiation is working. They are decoupling from the generic price war.
For now, but as I said, Xiaomi is the wild card. They are targeting the exact same tech premium consumer, and they have a much deeper pocket for sustaining losses than NIO does.
All right, let's move to our closing thoughts. We've covered the profit alert, the infrastructure moat, the risks, the investment case. Where do you land on all this?
I'll summarize my position like this. I acknowledge the profit milestone. It's impressive, and credit is due to William Li for the cost discipline. However, I maintain that the technical trend is neutral to bearish until the stock breaks that 484 resistance. The elimination round in China is real, and the transition to solid-state batteries poses an existential risk to the swapping model. I view NIO as a high-risk hold, not a screaming buy. The valuation is compressed because the risks are structural, not just sentimental.
And I'll summarize by saying the fundamental floor is set. 96% year-over-year delivery growth speaks for itself. The shift to an asset-light infrastructure model, combined with the multi-brand strategy of Onvo and Firefly, unlocks the next phase of hypergrowth. I view the current $4.41 price as a historic entry point. We're watching a company become a global industrial heavyweight, and this Q4 profit alert is the signal that the turnaround is real.
It's a fascinating setup, but that's for sure.
Indeed. For our listeners, keep your eyes on that 477 pivot point in the coming trading sessions. And I'd encourage everyone to dig deeper into the Q4 audit resolutions regarding the GIC claims. That will be the next shoe to drop, one way or the other.
Absolutely. Do your own due diligence.
That does it for this edition of The Debate.
Thank you for listening.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.